Hi, my name is Shane. I run the events over at 10 Capital Network, and we have another amazing one for you today. Just one thing during the session, if you have any questions, please feel free to use our chat box to send those in, and we'll get to them when we can. With that, I want to bring up Vishal Arora of Vdosh. He's our guest speaker today. And, I'm just going to give you the floor, Vishal, because you have a lot more interesting things to say than I do.
Thank you, Shane, and good afternoon, everyone. My name is Vishal Arora. Let me first share my screen so you guys can see the presentation that I'm going to share with you. Again, good afternoon, everyone. My name is Vishal Arora. I'm based out of Los Angeles, California. I'm a managing partner at Vdosh. It's a venture capital firm focused on a very early stage pre-seed and seed level startup. By profession, I'm a technologist, been working in technology sector for a long period of time, almost 23, 24 years. And in parallel, at some point, probably 7 years ago, 6.5, 7 years ago, I started Vdosh to solve a specific problem that I will walk you through in a while. Started that and started actively investing around 6 years ago. And today what I'm going to share with you is what we do at Vdosh within our venture fund, how basically we approach it, how we do the things differently than some of the other VC funds, and what we have done till now, and what our criteria and things like that basically to invest. So without further ado, as you see, our goal is to basically empower the next generation of startup funding. And little bit about Vdosh, founded in 2015, but that was initial formation that we did. And after that, for at least a year or two, we were trying to navigate through the things and actively started 6 years ago investing. We have an offices in Los Angeles and San Francisco because some of our venture partners are based out of San Francisco. So we have offices at both the places. We have a strong network of almost 5,000 founders across the world. We look at very large number of startups every year, pretty much in the range of 600 to 800. And as I said, I was a technologist by profession earlier, so we have a very strong relationship with multiple companies, for mainly the Fortune 500 companies out there, and some of the strategic partners as well. As far as our fund is concerned, our LPs are concerned, we have a very good network of some of the key LPs in our network, more than 500 accredited investors. And out of that, 300 are pretty much actively investing. We even have been lucky because we have multiple funds, and based on our performance track record and everything, our investor has repeatedly basically invested in our fund. And our offer are tailored. We have a pretty much very diverse offering around it. And right-hand side, what you see is the list of companies, some of the last companies that we have invested in. And I will walk you through that as we progress as well. So what do we do at Vdosh, right? Who we are as an organization. And as you see, our mission is to democratize the venture capital market for everyday investor. When I started this many years ago, I look at the market and there are many different venture capital firms. Some of the top ones are like Anderson Horowitz, Khosla Ventures, and some big names are out there. But these are big venture capital firms. Not everyday investor gets an opportunity to invest in this fund because you need a large amount of money to invest. But in parallel, if you look, so you need a large amount of money to invest. But on the other side, if you look at it within the United States, there are pretty much, I would say that 10 million plus credited investor, or even more now. And out of that 10 million credited investor, only 2 to 3 or 3 to 4% of the credited investor invest in a startup ecosystem, and others don't, because they either keep the money in a bank or some stock market or with some money manager or bonds or few other minor business deals. But on an average, they basically average 98% of the people averages out around 8% return. So the goal behind our fund and mission was to basically bring our vision was to bring the purpose and people together, the investor with the credited investor, with the basically cash flow, who really wants to invest in a startup ecosystem but don't know where to start or how to basically start. We wanted to provide a platform for them, and on the other side we also wanted to provide an access to the startup ecosystem where curated startups are available and they can invest. So we wanted to bring the startups and these investors together, and that's what bringing the purpose and people together means. As a firm, we are basically bound by a set of values that we have put together, where anything and everything we do in our firm is based on investor first policy. So we always make the decision which are in the best interest of our investor, because that's how we basically operate. That's how we build the credibility. That's how we have worked with our investor for many years. So investor first is our prime. These 4 values are our key values that we operate on a daily basis. Investor first, keeping transparency across the board, what is happening, how we are investing in a company, and providing an update on those companies on a timely manner as well. Accountability towards the investor, towards the founders, towards our own fund. And finally, last but not the least, is generating the result, because that's exactly why investor comes back to us and invest in our fund. So this just tells you a little bit about who we are. What we do, we kind of focus on, in a simplicity, we source the deal. We do that, we have a different channels. We are partnered with multiple channel partners. So we basically look at multiple deals. On an average, we look at 60 to 80 deals every month. We look at these deals, we identify the right deals that we want to do the due diligence on. We do a thorough due diligence, we invest, and then we manage. Overall, over the period of 6 years, we are currently raising our 4th funds. You could say that we had 3 funds. We have done 13 investment, and 4th one is we already raised, and I will share with you the details of that. And we already have 2 exits. And what this means is that if you look at it, one key factor here is, if you look at traditional VC funds, yes, they have unicorns and which offsets everything, but majority of the VC firms, they cover their returns within a small set of startups, but the failure rate is very high. In our case, we are very diligent about it. We want to make sure that it's not just a question of running after a unicorn. We want to basically go identify the companies which allows us to generate the return that we have promised, as a return that we have basically communicated to our investor as a part of our thesis, right? So the companies that you hear, and we are not delusional, we know what exactly we are doing. So one day we will have a failure. One day some of the companies that we have invested in might not basically do well. We are very well aware of it. But in 6 years, we have invested in 13 companies. We have 2 exits, and all the other 11 companies are exceptionally doing well right now. So we have a good track record in terms of how we go after the company. And this is the result of proprietary due diligence framework and the experienced team that we have put together within the Vdosh. Why we do it? Again, opportunities, strong returns, right? People will come and tell you that, hey, you know how we hear about all the unicorns and people making millions of dollars, but those are some of the exceptional stories some of the savvy investors are able to do. We wanted to bring the same set of opportunities to everyday investor, where we wanted to make sure that we give them another asset class which is a high risk, high reward asset class, but it generates more than exceptional result. Like, for example, my 4th fund, which I will share a little bit more details about, we are actually targeting, it's a 7-year fund, but we are targeting 50% year-over-year return, which is much higher than any other basically available asset class out there. Means there could be other better one, but at least it probably might fall into the top 1 or 2% of that. And strong return, and that is basically proven by all the already exits that we had within first 3 to 4 years that we had. How we do it? Unlocking the investment value requires a diverse set of experience, right? Diverse set of many different things. Our venture experience we have, and you will see that in how it gets reflected through our team. We have a right set of people with the experience, so that they bring that experience on the table. As I mentioned, I was a technologist. Majority of the company that we focus on, we do invest in every single industry except the CBD and gaming and a few others, and real estate startups, but we invest in all the other industries, and especially on an IT side of it, the software and emerging technology side, we focus a little bit more. And that's on purpose, because I have a very strong technical background. Some of my venture partners comes with a very heavy technical background and the business background, and that allows us to do the better due diligence and established network, right? We have some of our partners and some of the advisors and everybody are really basically connected or are from Ivy League school itself. That allows us to give that access to that established network, and our past experiences also allows us that access to the network that we have built over the period of years. So we leverage this in our basically due diligence. We leverage this in our how we approach it. It will leverage this in terms of sourcing all the aspect of it. Our smart and simple approach: we don't take a lead. We never take a full round. We always co-invest with others, right? We have our own due diligence. We do our own negotiation. And as I mentioned, that it all clearly thought out in terms of how we can generate the best, how we can protect the best interest of our investor. So our approach, we have simplified to the level that we could, to make sure that it's transparent, simple, accountable, and it allows us to generate the result. And our experience across the full life cycle, right? From deal sourcing to due diligence to negotiation and investment to board and portfolio management to exit. We look at all the full aspect of it and support that. Any venture firm that when you look at it, right, and what I mentioned in the previous thing, it's about multiple things, right? One is that how you source the deal. Right, you need to have an n number of companies coming to you, or you need to have a startup sourcing that you need to do. You need to have a due diligence process and in place, so you can analyze and select the company. You can negotiate, and then you can manage later on. This whole cycle that we talked about, one of the key part is deal sourcing, and what we have done is that we have created a stream network of channel partners, and these are some of them. 10 Capital being one, been working with Hall for pretty much almost 3+ years to 4 years. And these are some of the other basically channel partners that we have, from Expert Dojo to Pitch Global to Alchemist Accelerator to 1871 in Chicago to Matter in Chicago. We get our deals through all these channel partners, around 600, it's approximately 600+ deals every, but then only basically top 2 to 3% that kind of gets selected in the investment that we do. Overall, as you see, our goal is basically we are building an enduring ecosystem rather than merely kind of raising a fund and investing. And while doing so, we hold ourselves accountable, and basically to generate, we hold ourselves accountable to have a high performance standard for our investors that they are expecting from us. So that's how overall our ecosystem works, that how we approach this. As far as our team, this is me. I'm a managing partner. I'm the one who started this fund. I have some of the team members who are venture partners, advisors, legal team that I will basically share in a few minutes. My background, as I said, technologist. I was a developer for Microsoft, did consulting for many years for Accenture and many other companies. I've worked for pretty much 20 to 30 Fortune 500 companies during my consulting years. And I have a bachelor's and master's in computer science and executive MBA from one of the Ivy League schools. So this is my background. Been doing this investment for pretty much 8+ years now. This is my team that helps me across the board. Ash is one of the founder, a successful founder and entrepreneur He's an MIT engineer, and in his previous startup, he has raised almost 40 to $45 million from Intel Capital, Khosla Ventures, and multiple companies. And he's very actively involved as an advisor and supports fundraising for many other startups in Bay Area. Dhruv Joshi, he is also one of new team member. He's a venture partner, IT background, UCLA MBA grad, and now he's basically has been focusing on investment. He has been an angel investor for many years and now supporting the team. Marty is our legal counsel, and these are our esteemed basically advisors. James Russo is an ex Fortune 500 executive, C-level executives from a company, Legal Shield, and he was a president of Allstate on one of the subsidiary side of it. Srivan Akula is C-level executive for BMO Capital, and Dr. Vishal Arora is a plastic surgeon and also holds an MBA and has a very serial investor in multiple companies. So this is our core team who basically works on means the bottom team members are advisors, so they advise me on all the aspect of my venture firm, but the top part is the 4 people are the core team that we have. This is our portfolio, how it looks like. Some of the companies that we have invested, like DeepFX, it was bought by RingCentral, which is a publicly listed company. Versus Games, we were one of the early investors. They just did a series round at $200 million valuation. Some of the other companies that you see here, they have grown significantly in last many years. Skyla is one of the AI security company. They have raised millions of dollars in last 2 years. MediGuru is also in a telemedicine and ERM and all those technologies, and they are supporting their solution is white label to multiple hospitals as well. So some of the great companies in portfolio. SwissVault is based out of Switzerland, focuses on data center sustainability and storage. BU is CPG company. So as I was mentioning, majority of the things you will see are related to tech, but then time to time we diversify. Like Bui is a CPG company. MediGuru is healthcare. Skyla is this. The only gaming company that we ever invested is the GameTech, is the Versus Games, and these companies are doing really well in the startup ecosystem. Coming to the fund aspect of it, we are currently on our 4th fund where we started raising $10 million. We are planning to close this fund. It's currently we are raising it. We are planning to close this towards the end of this year. It's a 7-year fund. We are planning to invest in 30 plus companies. And in 7 years, we are targeting to generate a minimum 5x return for our investor. That's our bottom line thesis. And when you look at this 5x divided by 7, all of it averages around 55% year-over-year return. Focus early stage, pre-seed, seed. We are not afraid of taking risk. We are focused heavily on domestic. Time to time we diversify and kind of invest in an international company as well. Like SwissVault is a Switzerland-based company that I mentioned that we invested in. So time to time we go about it, and this just gives you a very straightforward what we do. We make sure that we are very reasonable in how we basically approach it. We aren't like traditional venture capital firm. We don't charge 2% management fee. Our management fee is only 1.25%. And we charge up to 20% carried interest, because carried generally varies between the closing that we do. Duration is 7 years, so 7 plus 2 increment of 1 year, so 7 plus 2. And and general partners have invested pretty much a 1% within the company. And we are very, very thorough, but very quick about making a decision as well. Because we know we understand the value of time and how quickly things move around. This is our investment strategy, fund investment strategy. Year 1, year 2, year 3, we will deploy the entire fund, $10 million. How we are going to approach it, and this time earlier funds that we had, we never did the follow on, but now we are also keeping some amount that we will be follow up, because we did realize that we do want to support these early stage companies in the next round as well. So that's where we are going to keep 30% on the side to support those follow-on round. And again, too much text here, but I will just focus on the bottom part. We focus on emerging technologies or use of emerging technologies, which improves the experience economy for B2B, B2C customers. Our criteria involves the basically startup companies, which kind of has a large opportunities. The market size is large. And we also look at the competitive landscape for that. Strong team is also one of our criteria. Sometimes having a one-man army is not a good sign, especially when you want to grow very fast. So we look at some of those team-specific criteria, their background, their experience in the industry, and then plus positive global impact. This is something that we do believe in, not necessarily we are always looking at it, but we do basically also want to make sure that any business we invest in is doing their responsibility towards the environment as well. And that's pretty much from my side about the fund that we have, what we do, how we approach it. Happy to answer any questions anybody might have.
Yeah, thank you so much for your presentation, Vishal. It's great. We do actually have one question in the audience. How would an entrepreneur or entrepreneurs find your fund different to work with from other VCs? Also, just before you answer that, I want to remind everybody, if you do have a question, feel free to drop it in that chat, and now is the time to answer those. Yeah, go ahead, Vishal.
So there are three parts to that. One part, as I mentioned, that we do have an experienced people on our team from multiple different industries, and if we don't, we know people in the industry. Like I went to one of the Ivy League school for my MBA. I have that network. I have my 24 years of experience network across some of the Fortune 500 companies. So we do have a network. We do have a network across multiple industries. We do have a network with some of the subject matter expert as well. So that is one part where we could basically connect the dots. Sometimes it's more important to connect you with the right people or connect you with the customer when you are doing an investment. So that is one way that we generally help. The second part is our philosophy is different than the other VC firms in some ways, and pretty much every VC firm or any firm will tell you the same thing. But the way we approach it is that we want to invest in your vision for your company and not invest and ask you to implement our vision. And what it means is that during our due diligence process, even it is an early stage, we will ask you lots of questions around it. Team, technology, traction, market potential, revenue, right? All the aspect of your solution and everything. The reason why we want to do it, because we want to learn as much as we can about you and invest in your vision rather than invest and then come and tell you that how you should be running the business, right? So that's one way how we differ. The second way is that supporting to the same point that I mentioned earlier, we are always here to help. We do have a capability, and not just our network or our experience. We also have a specialization in capital structuring, fundraising strategy, and lean operations, all the aspect of it. And we are always happy to advise you with that. But the thing is, we don't come and interfere. Our philosophy is that we make you aware that we are available to help, but you need to come and ask for it. So the only thing that we ask our basically startup is that we need to know, we need to get that update on a regular basis. So generally we expect, and that's part of our contractual agreement as well, that we ask them to provide us a quarterly update on the progress. But other than that, we are always happy to help, provided that you ask for it. Otherwise, we don't interfere unless we have any specific questions. So that's how we differ. We have created an ecosystem of support. We have experts available, and how we approach it. These are the things that we bring on the table, which I believe that we do a little bit different than the other people. I hope that answers the question.
Yeah, awesome. Thank you. Next question we have is, what is a general cap for a 100,000 investment?
Sorry, can you repeat that?
What is the general cap for a $100,000 investment?
What do you mean by cap?
I will let Nancy update her question. We'll move on to the next one. Nancy, if you want to give us a little more information, we can get back to you. Next, we got, what kind of support do you provide for the startups? I think that is a typo there. Yeah, what kind of support do you provide for your startups?
Yeah, so as I said, we are always happy to help, right? Means what type of support you need, let us know, and we can basically see that whether we can provide the support in those areas or not. We can definitely help you with capital structuring, fundraising strategy, helping you raise your current fund, next fund. Parallel to that, as I said, we do have a vast network of subject matter expert in all the different areas. So if you need specific help, if you need to get connected to somebody in an industry, and we can see if we have an access to them, we are more than happy to connect. So there are many different ways we help startup.
Great. Next question. Do you invest in seed stage therapeutics?
Yes, we do. As my initial selection criteria depends on 5 different things. I don't invest at the idea stage though. But we look at team, technology, traction, market potential, and revenue, these 5 things to start with, and startup needs to have at least meet certain criteria with that. So answer is yes, but we look at our parameter, we need to make sure that it fits into our parameter.
Sure. Next we have, is there interest in investing in seed clean tech opportunities?
Yes, means I invest in anything and everything that makes my investor money. Let's put it that way, right? Yes, I'm heavily focused on technology, and I try to stay away from crypto or some of the game tech or real estate or CBD side of it. But other than that, anything where we see the potential, we will definitely basically consider for an investment.
Great. Question from Nader. What is the portion equity that you ask for?
We do not ask for a specific equity. Like we don't have, unlike some of the accelerator and incubators, we don't have a tiers that, hey, for my 50,000, 100,000, 200,000, we need to have this kind of an equity. We look at the startup, we look at what their ask is, we do our due diligence. Based on our due diligence, we come to a price and get engaged in that negotiation part of it. And based on that, we decide that, and based on our interest, based on the price level of the company, we decide. But one of our criteria is that we minimum try to take 2% or higher equity. I hope that answers it.
Great. Yeah. Nancy updated her question. She said, cap is used in safe investment. What is the general cap for your $100,000 safe in a seed stage company?
So yes, means with different companies, it depends on the company. It doesn't depend on me, right? So and maybe I'm not understanding your question, so I'm going to answer in the way I understood it. Right, you're talking about that what cap for 100,000 investment, what market cap pretty much I might consider, or what equity I might take. I mean, hopefully that's what you are asking, and Nancy, I'm happy to clarify later on and answer that. But generally, company, depending on the parameter I mentioned earlier around team, technology, traction, market potential, their current revenue, they will set the stage, they will set the cap. And then when we do our due diligence, we analyze that whether that what their asking price is higher or lower, right? And based on that, we go back and talk to them. Now, our check size generally varies from $50,000 to $250,000, and depend on our interest in that company, we go with the specific offer that, hey, we will invest 100,000. This is the cap we would like to basically set to, and this is the level of equity that we will get. I hope that I gave you a clarity on that, but if not, happy to basically clarify and provide more insight.
Great. Yeah. And we can set up, introductions afterward if necessary to get more questions answered. Next question we have today is, what is your relationship with other firms? You mentioned not leading the rounds. Are you able to access their resources if you yourself don't have the network or industry connection?
Yes. So we one of the good example is that in this session that you are saying, right? We've been partnering with Hall and 10 Capital for many years, right? We have invested in some of the 10 Capital companies as well. where we found some really good deals and we invested in those. So we always, because we don't take a round, we are not leading a round. We don't think that virtually we have any competition, and we are not working with investing like millions of dollars like late stage VCs. So while our approach is in such a way that we don't have a direct competition with any investor out there, we always co-invest with them. And that has allowed us to build a good ecosystem where we partner with pretty much most of them. In fact, one of my company that I mentioned, I was one of the initial investor, and now they are doing a second round, and I am facilitating that, where one of the investor might take a full round and we connected them, right? So we do reach out to our ecosystem for help. Either it's a help in terms of getting introduced to customer, help in terms of getting introduced to SMEs or opening a door, or basically have an access to other investment firms at the later stage of your fundraising.
Great. Last question from the audience. I'm curious why no gaming, and then are education games also not a fit?
I wouldn't say it's not a fit, right? One of the things, the reason why I don't go into the gaming, because gaming is very, when I say computer science, means computer science is a vast field, from every different things, when you talk about mainframe to, digital side of it, to this and that, AI, and even within AI, you have so many different fields, right? Especially when you look at the gaming, there are so many different areas of gaming. And as we are a small firm, we are really good at what we do. And our primary focus is to generate the higher return for our investor, which we are committed to. Now, I can focus on gaming, I can focus on lots of other things, but we try to stay within the boundaries where we are really good at. I'm good at gaming as well, but I don't understand the gaming basically ecosystem that well. The day I have somebody whom I really trust in a gaming industry, who is a subject matter expert for me in a gaming, and who can basically help me with the due diligence, I might consider it. But for now, we are making sure that we focus on what we are good at, and maybe in future we might, but for now, it's just a vast field and we don't have enough energy to put all the efforts in that area. So that's one of the reasons.
Sure. I have one more question for you, but before I ask it, I'm going to release a poll to the audience. Just indicate your interest in Vdosh if you want to follow up. Just ran that now. And also everyone stick around because we're going to have two great companies pitch afterwards. So, and Vishal will be giving some feedback on those as well. So I just want to leave you with one more question. What is the biggest mistake you see startups make when launching their business? And how can they correct that? Let's go with that.
Well, I will talk from an investor standpoint. You are not going to make one big mistake, you're going to make many mistakes. And I would just say, don't afraid to make mistakes, but also make sure that you learn from it. Right? It's always a good idea to dream big, but keep it real as well. Like I have seen many times founder comes, even they might have an idea and say, hey, I have a great idea. I want to do a fundraising and my valuation is $15 million. Half of 70 to 80% of your investor will basically run away unless you have some exceptional idea, right? Because different areas, different basically, you need to keep things real, right? And that's where I think definition of real gets fuzzy from person to person. So be realistic about when you go to an investor, be realistic about your ask. That is one thing that I will mention. And the second part into that I will mention is, don't try to show in a way that, hey, this is $100 billion basically market. And even if I get 1% of that, I will have $1 billion. Means I see those slides and I always basically get off put by that. Means I'm least interested in that one, you taking a market share of 1% of $100 billion. I'm most interested in your journey going to that level, right? Because you're not going to get to that on a day two. You will go through the journey. You will fail. You are going to pivot. You are going to learn from all the surrounding. Don't be afraid of that. It's a part of the journey. The company I had an exit with, that company basically went through 9 pivotations, and 9th pivotation they were able to exit, right, over the period of 3 years. So just keep it in a summary. If I say, if you are going in front of an investor, this is something I'm telling you from my standpoint. Keep it real, keep it straightforward. Yes, you can dream big, but keep it real and make sure that you clearly communicate that, because they have this. I see 60 to 80 startups on a monthly basis. So I have seen a lot, and some of the people that you will go, they have been doing this for ages. They have seen more. So in a short, dream big, but keep it real when you go in front of investor, and keep very straightforward with them.
Great. Thank you so much for that advice. Next, we're going to bring up our startups. So I'm going to bring up Jonathan from Techless, and Vishal, if you want to stick around, we'd love to have your questions. And we're going to run polls after each of our presentations as well for the audience. So stick around for that too. Jonathan, whenever you're ready, I'm going to get your timer up.
So Shane, thank you for the opportunity, and thank you everyone for listening. If you have any questions, please reach out.
Yeah, and we will send follow-ups after the event tomorrow and connect everybody as needed, like I said. So thank you as well, Vishal, and we always love having you on.
Thank you, Shane.
All right, well, thank you, everybody. It's a pleasure to speak with you all today. My name is Jonathan Mesh. I'm Chief Product and Technology Officer here at Techless. Our founder wasn't able to join today, but I work very, very closely with him on all of what we do here. So at Techless, our whole goal is to create healthy technology, and specifically psychologically healthy technology, with the intent of bringing communities and families and individuals to a better balance in their life with technology. Our 10-year audacious goal is to reclaim 100 billion life hours of screen time for people to wonder, live, imagine, and connect. So you might think that this is sort of an interesting chase, and there's been some other startups that have gone down this space, but the market here is really fascinating. Many of you might have seen a dinner table conversation like this during the last few years, particularly during COVID. But what's fascinating is this is a very, very prevalent problem. Deloitte did a study last year where 164 million US adults want to cut back on their screen usage, but 99 million, that's 38% of US adults, have trouble cutting back on their screen usage. This is a pretty prevalent problem. And what's fascinating is it's even more prevalent in teenagers, because the trends are starting to change. So for teenagers, this is a big issue. Over the time that smartphones have been around, there has been a 4 times increase in teen suicide rates. And that 38% number for US adults is actually higher. It's 59% for teenagers today in the US. 59% of teenagers have trouble cutting back on their screen time use. Of course, this is a problem that parents worry about as well, almost unanimously. And what's fascinating about this is you might ask the question, well, I thought Google and Apple were doing something about this. I'll tell you what, I used to be a Google product manager on Google Family Link and products for families and kids while I was there. Google makes $50 billion on the Play Store, and Apple makes $84 billion on the App Store, plus many more billions on ads. So the reality of this problem for them is that while they will invest a little bit, and they invested a decent amount in 2018, during that time period, that's the limit. They didn't really do a lot more beyond that because their existing business models are tied to the attention economy. So that is what we are changing at Techless. And that's why we created the Wise Phone. This is a pure and simple phone that's really designed to help people live in balance with their technology and disrupt that attention economy. So the Wise Phone today has been sold already. We've been sold a few thousand units, and it has just the functions that most people need to live their daily lives. It's got a great phone, messaging, a great camera with pictures and whatnot, maps, music, podcasts, notes, clock, calculator. Those are just the set of apps that we have today, and we'll be growing those over time. And what's fascinating is with this simple set of experiences, people are finding really, really interesting changes in their life. So the users that we have today, I've done a lot of interviews with these users, and they loved the simplicity of this device. They love the aesthetics of it. It kind of has that book-like feel in the same way that people kind of love reading a Kindle rather than reading on a tablet. But most of all, people loved what it isn't. They love the way that it doesn't suck them away from their relationships, from their kids, from the things that they want to focus on. And as they found that they loved those things, they experienced more presence, more focus, they experienced less anxiety, and they experienced feelings of freedom that are consistent with getting out of a dopamine addicting behavior. That's exactly what people are going through when they experience WisePhone and get used to that. Here's just a few quotes of different users that we've talked to. The top left, this user said WisePhone was an immediate sense of release and relief. The top right, we compete right now in some minimalist smartphone markets, but this is a gentleman who has used one of the primary competitors in this space, the light phone, says that this phone is far superior. The bottom life, this person is truly living a better life with WisePhone. And the bottom right user summed it up really nicely by saying, WisePhone is convenience without anxiety. That's what we're going for. So we've got really, really fantastic reviews on our customer satisfaction interactions via email and chat. 99, I think we're down to 99.95% right now. So a little dip there, but nothing to worry about. But all of this combined, the vision of what we're trying to do, the product that we've put out there, and the incredible customer service that we're giving out has led us to have a net promoter score that's the same as Apple's, 61. If you're not familiar with net promoter score, it's a scale that goes from -100 to 100, measuring how likely someone is to recommend that product or company to someone else. We're the same at Apple, higher than Chick-fil-A, higher than Google, higher than Target. We've done all of this on just 2 million invested. We've sold $1.5 million in revenue. We've sold 3,000 units, and we're on our way toward the next generation of that device. So today, the WisePhone sells for $399 at retail. And if you look at our website, you might see that we've sold out, and that's an intentional move. And we're actually looking at relaunching a rental program, but that's partially because we are moving toward the WisePhone 2, which will have a lot more functionality, a lot more inventory availability. And the other tweak that we're going to make here is we're actually changing the way that cell phones are sold. We're going to be selling this phone at cost and then charging a subscription service to use the OS and the apps and bundle that in with carrier services via an MVNO. So with that new model, that allows us to move toward more of a SaaS-based revenue, which is ideally what we would like to be anyway. We actually started out, we've tried doing this as SaaS only. We launched this on the Play Store, but the challenge is the experience is really poor. If any of you have used launchers on Android, the experiences of that are really poor, and they're very, very limited by what Apple and Google allow you to do. So we tried that, and we've actually found greater success by moving down this route of selling the hardware with the OS installed. So what these margins and what these costs look for us like is that we can get to a point of profitability with just over 1,000 units per month. And for reference, we think some of our competitors in this space are shipping somewhere in the range of 10 to 20,000 units a month. So what that means is that in the rest of this year, with the investment that we are seeking, in 2023, we are moving toward that WisePhone 2. And beyond the SaaS change there, we're doing another number of other things because we have what I would say right now is a minimal phone. Our desire is to move more and more, and we are doing this, moving toward a healthy phone. Because there are plenty of things that are very, very useful in our modern technological lives that aren't addicting, aren't distracting. No one gets addicted to their multi-factor authentication app or their parking app or their banking app. Those things are very useful tools. So we want to actually move to a place where we launch a third-party ecosystem. And the nice thing is that this is under the hood, it's Android. So technically it can run any Android app, but we want to change the model of how developers deploy and monetize their apps to ensure that we're always respecting user attention and respecting the lives of those 99 million US adults, the 10 million US teens, and millions more around the world who are interested in this. So on the right, what we're doing on the marketing side is we're actually partnering, we're targeting a set of users that is consistent with the functionality that we have on our phone now, specifically teenagers. So we're partnering with some leading advocacy organizations. We have a book coming out that we're co-writing in just a couple of weeks. There's a documentary that we're working on, and the goal is to go to teens who are raised in highly intentional homes. These are parents who otherwise would not let their teenagers have a smartphone until they're 14, 15, 16. And specifically, we're targeting that demographic because there are kids' phones out there, But by the time they get to that age, they don't want a kid's phone, and adults don't want a kid's phone either. So we're going after that market while we also continue to grow into the healthy phone market that allows us to go beyond the minimalist adult segment into a much broader audience. We do have some competitors out there, but we are best in class among minimalist phones. We're the place that people go when they get frustrated that their lockdown smartphone isn't really solving the problem. I mentioned kids' phones already, and the way that we're really trying to solve problems there and launch to an adult and more mature market. And then there's some privacy focused and there's some flip phones out there, but neither of those really solve the problem well. So just that's based on, that's what we're doing. The team is Chris and myself. Chris is really brand oriented, and he's done a phenomenal job at building the brand of Techless and helping people understand the vision of what we're doing. For myself, I built $1 billion product at Google Optimize. That was my baby for about 4 years. And have gone on to run teams of 40 in large healthcare organizations and behavioral health organizations. And that's a little bit about us, but we've also had a number of partners along the way. For those of you in Texas, you might have heard of Capital Factory. We have partnered with some other organizations like Praxis and the Eagle Venture Fund, who have been our chief investors so far. Won some awards at various places that we've been, Lions in South by Southwest, and been featured in some large publications like Gizmodo. And that leads us to our current fundraising perspective. We've raised $2 million to date, as I mentioned, and right now we're in the process of raising a convertible note bridge round of $1.5 million. That gets us out the door with our new phone. It allows us to launch a large pre-launch campaign, pre-order campaign, and that also paves the way for us to move to that seed round that we're targeting in the fall of an $8 million raise. So that's about all I have for right now. Happy to answer any questions that you might have.
Great. Thank you, Jonathan. I want to give Vishal the opportunity to ask his questions first. So Vishal, if you have any questions, feel free to pop back in.
Thank you, Shane. Jonathan, couple of questions. You are raising a bridge round of 1.5 at what cap or what valuation?
So because it's a convertible note round, we're not setting a valuation at this point. We did have an 8 million round. The previous round was an 8 million valuation. We anticipate that it, might be around the double of that range, but we want to let the lead investor set that.
And you are expecting that next round you will do basically will be a prize round?
Yes.
And about your unit, you mentioned $399. What's the unit economics looks like for that?
Yeah, let me go back to that slide. So right now, the cost of goods sold on that is about 110 per device. We have fulfillment and processing, and then CAC. So that's kind of what you're seeing on the slide here. In the future, moving toward the new one, the unit cost is a little bit higher. Fulfillment's a little bit lower. Processing, all of these are pretty similar. We're in the process of continuing to bring down our CAC. We've really kind of like nailed in and locked in on influencer-based marketing to do that. But that's also where we're shifting the model to be bundled with carrier services on the revenue side. And because these users don't use much data, we're able to offer usually a very competitive plan for these users that is much less expensive than our existing carriers.
And these plans that you are talking about, have you established any sort of partnership with any of the carriers?
Yeah, we're in conversations with Plum Wireless, which is the white labeled version of Mint Mobile right now.
Okay. Okay.
We've actually been distributed through US Cellular in the past as well.
Okay. And you mentioned that you guys have already sold 2,000 units.
3,000, yeah.
3,000 units. What period of time that you have sold 3,000 units?
That's a lifetime, I believe, over the course of the last year on this generation. We did have some previous generations. This generation, I believe we've sold about 2,400 in the last year.
Okay.
2,500. Yeah.
And you mentioned some of the changes that you are bringing on the table. Those changes is part of your go-to-market strategy, if I'm not wrong.
Sorry, which changes in particular?
Changes in terms of, you mentioned that selling a phone at the cost and then
Yes.
have a subscription approach and everything that will be implemented or that will be launched with the new phone.
Yes, that's correct. Yeah. And so much of our value prop there is people are getting used to this idea that if the product is free, they are the product. And we are kind of trying to upend that and say, with Techless, you are never the product.
And is your website is the only medium that you are selling it from, or you are also establishing a channel partnership across?
So right now, historically, that's been our only path, but we're in the process of establishing a lot of affiliate relationships and partnerships. The nice thing about these audiences that we're actually targeting homeschooling associations and religious private school associations with the intent to, again, use those as a proxy for highly intentional parents, and also establish sort of like these communities of people who are accepting of this idea and kind of moving toward that together.
Yeah, thank you. I think that's pretty much what I wanted to know. Thank you, Shane.
Thank you.
Awesome. Thank you, Jonathan. I just launched a poll for everybody in the audience. If you could just take a moment to fill that out, we'd be happy to get back to you if you're interested in following up. We have a couple questions from the audience with the rest of our time, Jonathan. So, and I think you touched on this first one, but I'll let you dive into a little bit. Curious as to how people split their time currently on these core apps versus the dopamine apps. I ask because I feel I spend a significant amount of time texting and messaging at the dinner table. I am texting my friend, not playing games.
Yeah, it's a great question, and we don't have specific stats on that. I think one of the things that we are really trying to do differently, though, is to move to a place where we can actually design apps, even everyday apps, with high intention in a way that people don't today. So as an example, email is sort of a perfect example that we've been brainstorming about. Email is both a really fantastic tool, and it's also a source of some of the most addictive behavior. If you get a reward 50% of the time, that is the most addictive ratio. So we actually have some interesting ideas on how we redesign that to take advantage of the best of the tool side of that while eliminating the addiction side of that. And I'm not going to share that right now, but I think to the point of like texting and messaging, there are things there that we actually have moving toward this next generation. There's actually a switch on there that we're calling a do not distract switch that might help people, again, focus more on the relationships in front of them. But there's a lot of other things that we're continuing to pursue in those areas.
Great. And I'll let you just answer this last question. Do you promote via AARP?
We've not to date. It's a great suggestion. We do have a number of users who are elderly and value that simpler experience. We have a lot of really fascinating markets that we can pursue in the future. We've explored B2B. We've explored this as a digital therapeutic via psychology and psychiatrists and therapists. And I think ARP could be a really valuable channel. I think this is indicative of the stage that we're at, that we've not been able to kind of like go after all of these channels yet. We've really tried to hone in on sort of what we think is that most valuable next channel right now.
Great. Well, thank you, Jonathan, for your presentation and answering all those questions. We'll follow up afterward with everybody who's interested in, making a further connection. And with that, I'm going to bring up our next guest.
Thank you.
Can I have the Casada team come on up here, and I'll get your timer ready in a second.
Great. So Jonathan, Vishal, thanks for the awesome presentations. I love what you both are doing. It sounds really, really interesting. And thanks Shane and the 10 Capital team for the opportunity to present here today. I'm JP Sigmund, the CFO of Casada, and I'm excited to introduce you to what we think is a really innovative, housing development concept. Casada is a high-growth build-to-rent multifamily real estate developer focused on delivering high-quality micro-home communities at an affordable price point. Casada is a little bit different than most of the other investment opportunities you're going to hear about on the 10 Capital Network. While Casada leverages technology in every aspect of our business, we're not a technology company. We provide investors with an opportunity to achieve returns that are in line with what you'd expect from a high-tech growth firm, but an investment in Casada is actually backed by real assets. Now, the reason we exist is really a massive problem that's been across the US. Everybody knows about the problem of affordability in America. Decades of chronic underbuilding and lagging construction sector productivity have left over 20 million households in the US cost burdened. And by cost burden, we mean basically where your rent or mortgage plus your utility payments is more than 30% of your take-home income. Now, just imagine that 40% of renters and 20 million households are in that position. So in order for tenants to actually afford their rents, they've been left basically paying for underwhelming housing options. So we think that the real way to alleviate America's housing affordability crisis is that developers need to start deploying more advanced construction techniques, using things like off-site construction and prefabrication. These modular construction techniques are going to be able to reduce project costs and accelerate timelines while still providing high-quality, sustainable developments. Now, this is exactly the slide that Vishal mentioned that he hates to see, so I'm going to go by it really, really fast here. But suffice to say that it is a massive, massive market of unaffordable housing. There's a huge demand for affordable housing in the US, And we think Casada has cracked the code on how to develop attainable housing that other developers aren't doing. We're focused primarily on expanding in middle market cities that are experiencing job and population growth across the southern and southeastern US. Now, Casada is a solution to the national attainable housing shortage with unique modularly constructed micro single-family rental homes in amenity-rich communities. We develop environmentally conscious communities where each unit serves as its own single-family dwelling. The concept is akin to a multifamily vertical apartment, except that every Casada unit is a standalone unit, having indoor and outdoor living areas and access to common areas for amenities for residents. And we've already laid the groundwork for rapid growth across the country with partnerships with nationwide manufacturers, allowing us to reduce our project costs by approximately 20% on average, and we accelerate our timelines by up to 50% versus your typical multifamily development. And we've already proven this concept out. Our first community opened in February of 2022. It was 66 units, and we completed it in under 12 months. For reference, a typical apartment complex takes anywhere from 2 to 3 years to build. So we've really been able to cut timelines down. And the community was a resounding success. It opened 82% pre-leased, stabilized within 90 days. We were 100% occupied within 120 days. And we've already recapitalized and refinanced the project. And it's also worth noting that we nailed our target demographic with the median salary of our tenants roughly at 80% of the median income for the Austin metro area. So we really did create something that was a workforce housing product. And we've already seeded the pipeline for our next 3 communities, with our next one breaking ground this summer in San Marcos, this winter in Bastrop, and in the spring in College Station. We are out actively sourcing land in the DFW, Houston, and San Antonio areas as well. And we've already received strong interest from partners outside of the state, and we anticipate launching our first out-of-state project within the next 18 months. Now, again, let's get into the actual Casada project. So Casada offers the best aspects of both multifamily and single-family living. Unlike a traditional multifamily development, our units are completely standalone with no shared walls, ceilings, or floors. So we provide tenants with a level of independence that's typically only found in a much, much more expensive single-family house. And our micro homes, so as we call them, typically range from about 400 square feet on the lowest end to around 1,000 square feet. They're tech-enabled, they're modern, they're eco-friendly, they have highly, highly functional layouts, they're energy efficient, and they've got high-end finishes throughout. The communities include physical amenities such as naturally landscaped buffer areas, modern co-working spaces, fitness centers, outdoor pools, and extensive green spaces and community gardens. And we also bring in an experiential aspect to our communities, where we have basically a person on staff who does event planning for on-site concerts, fitness classes, volunteer opportunities, and even more than that. So at the end of the day, what Casada is providing for our tenants is a much higher quality of life, but our rents are in line with what you might see at a typical Class B apartment complex. And a Class B apartment complex, what I mean by that, they're typically aging, they're 15, 20 years old. Somebody may have come in and done a renovation and upgraded the countertops and put in some new appliances, but ultimately you got low 8-foot ceilings, small windows, and you got people on all sides of you. When you look at that and pay the same amount versus a Casada community, it's a no-brainer. We think we have the right leadership team in place here. You've got myself, JB Sigmund, here in the middle. Aaron Levy is our CEO, and he's a multi-generational real estate developer with over 15 years experience building in Texas. I have about 15 years experience in capital markets, with a number of Wall Street firms. Our COO is on the phone here today, Noah Pollock, and he's got over 30 years leading various high growth organizations as well. So what we're raising today is we're raising basically looking to close out a $2 million round. We've already raised about $700,000 of that. This fundraise is going to be used to alleviate our near-term cash flow gap and accelerate the growth of our pipeline. And we're targeting a sale of the entire business and the entire portfolio that we are building within the next 5 years. And we anticipate producing roughly a 10x return on our pre-money valuation of $15 million, which will generate a 50% IRR to investors over those 5 years. Now, I'll run really quickly through these next few slides, then we can answer, spend time on it during the Q&A. But basically, each Casada community is a separate SPV, special purpose vehicle, where Casada is the developer, the operator, and the general partner of each of those communities. The rest of the project of each one of these projects is financed through third-party LP capital, limited partner capital, and construction loans. Casada typically ends up investing around $1 million into each project, which is about 10% of the required equity and about 1/40th of the entire budget of each project. So during construction, we'll earn a developer fee of 4% of the construction cost. So $40 million is a typical construction cost of our projects. We'll earn about $1.6 million in developer fees over the 18-month window that we're building each project. So we basically earn our money back within 18 months from what we invested into it. Once the project's finished and leased up, we charge a management and licensing fee that's equal to 4% of rental revenue. But the big driver of value for Casada is the carried interest that we earn in each project. To incentivize Casada to maximize returns on every individual deal, a profit-sharing waterfall is entered into between Casada and the limited partners who invested in that project. And this profit-sharing arrangement provides Casada an outsized return vis-a-vis the amount of money we actually invested. That's called our carried interest. So our carried interest in each project, if we hit our investment returns of around a 25% IRR on each project, will mean that Casada will walk away with over 30% of the total equity in the project, even though we put in 10% of the required equity. So when you put these different pieces together, by the time when you go from the time their project was started through the cash flow we earned during its construction and operations to when it's ultimately sold, Casada will earn around a 10 times return on each project that we do. And we think we've already laid out the massive trajectory of growth on here. We're building the team that's capable of starting on 4 projects a year, which is going to allow Casada to be cash flow positive and self-funding within the next 12 months. And what I mean by self-funding is that virtuous cycle begins after that point where every time we invest money into a project, we'll be earning back more than we put into it over the next 18 months, allowing us to then self-fund and keep doing new projects going forward. This growth trajectory is going to propel Casada to a $140 million valuation within 5 years, which is approximately a 10 times multiple on our pre-money valuation of $15 million, and it represents a 50% IRR to investors. So what questions can I answer here?
Great, thank you, JB. We did have Vishal drop off. He had an emergency, and he asked to specifically to follow up with you with his questions. So I'll make that connection afterward. With that, I want to ask the audience, if you have any questions, please feel free to drop them. It looks like Mark had a few notes for you there. He asked to connect about air quality in the micro homes if you're interested after he left his email. So we can get that for you as well. Yeah, my first question is, and you may have touched on this a bit, but just differentiation and competition. What does that look like? And what are you doing to stand out, or is there any competition? I guess I might have missed it, but
yeah. So you can think of competition 2 ways. One is there anything like Casada in the market? There's not a lot exactly like it. We're competing for dollars from from tenants from either single-family rentals or multifamily rentals. There are some manufactured housing communities where people may be able to rent a single unit at prices that are similar to where we are, but it's a totally different quality of life, much lower quality. So we have not been able to find anybody that's exactly what we're doing, and that's where we think we're unique. But there are other, townhome developers and things along those lines. They just don't have anything quite like what Casada has.
Great, and I just launched the poll for Casada for the audience, and if anybody has any other questions, please drop them in there. Otherwise, please also feel free to answer the poll as well. But I actually don't have any other questions, so if the audience does, I'd love to have those be answered as well. Otherwise, we can also follow up with questions in email. But yeah, are there any last words about Casada that you want to iterate, leave a lasting remark here?
No, I think for me, the big thing that's exciting about Casada is that we're doing a proven business model. We've already launched a couple of communities. this is not something so outside the norm. There's people doing real estate development all the time, but we're just doing it faster and basically giving an opportunity to have outsized returns that your typical investor is not going to see in a real estate investment.
Thank you so much for your presentation, Casada team and JB specifically. I want to thank everybody for joining us. That brings us to our time today. I want to thank our presenters, JB, Noah, Jonathan, and Vishal. It was a great event today, and we'll be following up with everybody afterward for interest levels, introductions, connections, all that good stuff. And we'll be sending out the recording as well, along with our Eventbrite page where you can find more events like this one. So feel free to sign up for anything in the future. And with that, we're going to go ahead and close it out. I want to thank everybody one last time and have a good rest of your day.
Thanks, Shane.